Good morning, good evening, good night, wherever you may be watching this transmission. Tis I, Mike Martins, back with another Canadian real estate update on what's going on, and I got a really interesting story. So if you're just jumping on the channel, guys, go back. A lot of people are asking me the same similar questions, and go to my channel, explore it, and go to my housing market, trends in the housing market shows. A lot of the questions that you're asking me are answered in those lots of videos that I've already answered in the past. I've been doing real estate videos now. It's going to be like 9 years now, predicting this tsunami, and it's happening. It is happening. Now the fun part starts. It's the great blame game. It's the great perfect storm. Who's going to blame who? It's going to be everything. It's going to be phenomenal. Yeah, so here goes. This article was sent to me by a friend, Owen, who sent me this. And Canadian real estate industry is pressuring Ottawa to get you further into debt. Okay, and I know you guys, I've said this before, but we're a nation, or not even a nation, we are a society of debt creation, no more wealth creation, and it's super scary. For me, I do layaway. If I want to buy a vehicle, I save up and I just buy it. Allowing me to have further disposable income to support my family and future ventures. I'm saving money now to hopefully secure a commercial building for me to run my current business. And I am running out of a commercial building right now, which I'm renting. It's a disaster. Watch my videos on that. It's an absolute disaster. The building is falling apart. I did a walkthrough. Now I'm securing, and the banks won't touch me because I'm business for self. They won't even do a line of credit on a house that's free and clear. My house. They won't even touch it. So, fair enough. You work hard. You put the money aside. You will. I promise you, you will achieve your goals. You don't have to buy now and pay later. And this is the problem that's happening. People, because back in the 70s, 80s, and very, very early 80s, is that a lot of people are forgetting that credit cards weren't so readily available. Neither were lines of credit on your house. You got to jump through hoops at the bank to get that kind of stuff. To get a credit card? You want a credit card? Are you serious? This is before ATM machines even existed. This is before everything, right? So nowadays, the easy access to funding or borrowing on your signature, and then now borrowing on your home, is almost like people are treating it as they won the lottery when they haven't. And then making it pay, and then paying it back and thinking, well, it's only 10 grand. If I make the minimum payments, it's going to take you like 15 years to pay it off, and you're going to pay like $17,000 in interest for that $10,000 if you make the minimum payments. So that's what people are forgetting. Even if you double up on the payments, it's going to take you a long time to pay. So watch out with that revolving debt and blended rates, especially when you have blended rates, when you have a bunch of credit cards and lines of credit, you're paying a blended rate. And it hurts. So now the Canadian real estate industry is pressuring Ottawa to get you further into debt. Why? So let's read this. I never read this yet. According to the industry, the problem with Canada's housing market is we're paying off our mortgages too quickly. What? Are you serious? Canada's real estate industry must be getting worried that the slowdown is going to hurt its bottom line. In the past few weeks, we have seen insiders launch a full court press against the country's federal mortgage housing rules. Prominent voices among retailers and mortgage brokers have joined with economists and some of the country's largest banks, i.e. mortgage lenders, to call on Ottawa to revisit mortgage stress test. But that's what's fixing our problem and creating a level of affordability. The test, which essentially requires borrowers to qualify for a mortgage at a rate that is 2 percentage points higher. That's really good, because then now people are stressed to the max. Well, what if it goes 5 points higher? Then what? Then what they're being offered is now Obsolete, they say. It's made sense a few years ago when interest rates were at historical lows, but it doesn't now. It doesn't now that rates have risen. So what do they want to do? Raise rates? Mortgage Professionals Canada, a national industry association with represents some 1,000 mortgage businesses and 1,100 individual mortgage brokers. The oversupply of mortgage broker is another story. Suggested the stress test should be set at 0.75% above the offered rate. I think that's very slim. That's very slim. Maybe 2-3% is fair. But once again, it's not the mortgage brokers that are themselves lending out the money, and it's not these companies that are themselves lending out the money. It's the banks that are taking the risk. Given the discount rate of a 5-year fixed mortgage in Canada is around 3.7% today, this means the industry version of the stress test would only ensure that borrowers can handle 4.45%. Okay. That's in a good normal housing market, 4.5 to 5.56% is normal. In a regular normal market, we're still not in regular normal market territories when it comes to interest rates. You know, is your bank paying you on your bank account like they did 10, 15 years ago? No, you're getting 0.001% on your bank account. You have to have $1 billion in your bank account to make $10,000 a year nowadays. As if higher interest rates then that were impossible and now worth testing for. Fun fact, the current going rate for a mortgage in the U.S. is 4.41%. Mind you, in some of the major cities in the U.S., you could still pick up a house, you could pick up a condo under $60,000, and you can still pick up a house under $170,000, a good one, under $170,000. The problem is, the average house in the Greater Toronto area is like $1 million, and $1 million for a teardown in Vancouver. So, I mean, we don't have a lot of cities like the U.S. does, so it's kind of tough to kind of gauge both countries. But what I'm saying is, yeah, 4.45% in the U.S. is okay because you're only servicing a $200,000 mortgage, right? In the U.S., though, to get a rate for 30 years, not so in Canada, where the typical mortgage term of 5 years, but the typical amortization of 25 years. Okay, a Canadian mortgage is a gamble on where interest rates will be up to 25 years from now. Are we sure they won't rise above 4.45% in that time? Some historical context as recently as 20 years ago that going discount rate on a 5-year fixed Canadian mortgage was 8%. It only dipped below 5% when the Bank of Canada dipped its key lending rate during the Great Recession a decade ago. So when it was up that high, that's when bank accounts were paying you 4.56% on your bank accounts. That was amazing. You put $1 million in, you get 60 grand a year if it's at 6% on your savings account. That's when your money actually had value. Is it really that inconceivable that mortgage rates could return to those levels again in the coming years, especially considering that we are coming off interest rate levels that are the lowest in 5,000 years in human civilization, meaning that there's little room for them to come down and plenty to rise? Remember, guys, you guys need to remember in the video I did a few weeks ago, there's no playbook. There's no playbook in existence right now for what's happening and how to fix this housing crisis issue. Playbook doesn't exist because in human history, we've never, ever, ever lowered rates this low. We've never played and artificially deflate rates. And it's basically, it's a form of corrupt wealth creation and the deregulation of a banking system that was doing fine until they had to start playing with it, right? And then now we are in a position where people are leaving the major cities because the Canadian proper, Australian proper, New Zealand proper, UK proper can't afford to live in their own major cities. If we were serious about preventing Canadians from overextending themselves to the point of national debt crisis, we may have to consider the possibility that the stress test may actually not be stressful enough as it is. And apparently the industry believes that a 25-year gamble on interest rates is too safe of a bet. Another policy move, they want to see the extension of insured mortgage amortization to 30 years from 25 years. Okay, Guys, look at a mortgage rate calculator, okay? Look at what the difference in payment is from 25 years to 30 years. It's like 50, 70 bucks a month. So you're going to pay an extra 5 years of mortgage when you could just pay the $50, $70 a month. Pay attention. It's like doing a 5-year amortization on a personal loan or a 4-year. You do a 4-year, you pay an extra $19 or $22 a month, okay, on a $5,000 loan. You do a 4-year, okay? Do the math on your own calculator. You do a 4-year, it's going to cost you an extra 20 bucks a month to do it 4 years. But if you do 5 years, guess what happens? You save, you pay an extra year, but you save the measly 20 bucks a month. Not worth it. Better to pay it off in 4 years. If you can't get Canadians to take on higher mortgage payments because they already have a G7's highest debt burden and are becoming to freak out about what they owe, well, maybe you can get them to take debt for longer instead. That's a big no-no. Back to 2012. This would be a reversal of policy in the place of by then Finance Minister Jim Flaherty, who reduced the maximum insurance mortgage amortization to 25 years from 30. He did so because of the concerns that house prices were rising too quickly and Canadians were taking on too much debt. The bank in 2012, when Canadians owed $1.62 in debt for every dollar of disposable income. I covered that article actually. Instead of the current levels above $1.70, and yet somehow it's safe again to extend mortgage lengths. The Canadian Home Builders Association says Finance Minister Bill Monroe is considering bringing back the 30-year mortgage. Oh, Christ. Some experts believe that Monroe should think twice before increasing Canadians' debt load while pushing high house prices even higher. If you consider the amortization period, you'll have people taking on more debt, and as a result, you'll increase prices. National Bank of Canada economist Kyle Dumas said recently, it's hard to say if those are the right solutions. And in other words, affordability will worsen still, even if Canadians are sadly with more debt. It takes some serious verbal acrobatics to sell this policy. The current limit of 25-year amortization for insured mortgages results in a very high rate of forced savings, Mortgage Professional Canada said in a recent report. 30-year amortization periods would also result in rapid paydown of mortgage principals and growth of homeowners' equity positions. Translation: Canadians are being forced to save money in the form of home equity too quickly, never mind that their parents had a 10-year amortization. If only we could keep ourselves in debt to the banks longer, it would all be okay. Oh my God, mortgage. Here's a graph here. Average household debt. So here it is, guys. Back in the 90s, look at the household debt, how it was under control. Barely any the country was barely in debt. The GDP was going strong. Canada lost everything. Canada sold everything. We sold our jobs overseas. Then we sold out to many other reasons. And then we ended up selling out our housing. Canada sold itself completely out from housing, our water, everything. Here's a solution. Leave the very reasonable policy measures in place and let the market do its work. If the industry insiders are right and people just can't hack the stress test, then eventually sellers will have to lower their asking prices. Yeah, that's exactly what it is, guys. And then, surprise, affordability will return. Canadian homebuyers will be able to take on more reasonable levels of debt. And the long-term trend of rising house prices will be able to make a comeback. Yes, homeowners would have to contend with a decline in value of homes. I mean, I've taken losses in stocks over the years. I've taken losses in investments I've made. I've taken losses in bad business decisions I've made. Yeah, you know, it happens, guys. I've done it too, you know. Home buyers in expensive markets would have to save longer for the home they want or downgrade their expectations. Sorry, guys. To meet stress tests, real estate agents would have to make smaller commissions. Developers would see lower profit margins. Some land and house speculators might get wiped out. But hey, you want to see a real economic disaster? Just let home buyers keep taking on more debt until one day a tiny increase in mortgage rates or a small dip in unemployment knocks the whole economy over like a shack in a desert sandstorm. We're gonna have to pay the piper eventually for excessive, unsustainable house prices growth that has left home affordability at its worst levels in 3 decades. Better pay today's price than a much bigger one on offer tomorrow. Well, this stress test should have been in since the time of Moses. I don't know why they do this, you know. And the sad part is these people are taking so much debt to it's not even to open a business, because a lot of people took on debt back in the day to open a business. Now people are taking huge amounts of debt today just to pay a house or to buy a house. 20, 30 years ago, people would take on debt, to start something, employ people, export, produce, fabricate. It's gone now. It exists, but it's gone. Let me know what you guys think in the comments below. This is a Canadian real estate update, and don't forget to join me on Wednesday nights for Trends in the Housing Market live show on my backup channel. Thank you for watching, guys, and have a great night.